Good morning, everyone. Welcome to the Foreign Correspondents Club of Japan here in Tokyo, Marunouchi, to be precise. I'm Anthony Rowley. I'm former president of the club, and I'll be acting as moderator today. This is another of our what we call deep dive series, where we invite panelists, expert panelists, to give their views on topics of current interest. And we have a topic of very current interest today, which is inflation. And we've entitled it, Roaring Back, How Far Will It Go? I think those are the questions on many people's minds at the moment. And we're fortunate, again, to have three eminent speakers to talk to us on the subject today. We have, sorry, forgive me, I'm looking at the wrong prompt sheet. I'll introduce them in the order that they'll be speaking. First, joining us from New York, we have Dr. Paul Sheard, who's a research fellow at the Harvard Kennedy School's Mossavar-Rahmani Center for Business and Government. He's a former chairman of S&P Global and former chief economist at Lehman Brothers, Nomura Securities, and Standard & Poor's Rating Services. Secondly, we have Hiromichi Shirakawa, who's joining us here in Tokyo online. He is managing director and vice chairman and member of the board of directors, and also head of economics and Japan chief economist at Credit Suisse Securities in Japan. And we also have Jesper Koll on my left here, who's expert director at Japan-based Monex Group and former managing director and chief economist for US investment banks JP Morgan, Japan Securities, and Merrill Lynch Japan Securities. So, we had a deep dive on inflation just 3 months ago. And with the same speakers, and we're very happy to have them back. So you may wonder perhaps why we're doing the same event, as it were, but obviously things have moved on since we had the last speaker, the last event. To begin with, there's a war on, a hot war, and also a sanctions war. The global economy, is facing a huge supply shock. Inflation has taken off, and therefore interest rates are also taking off. And as interest rates take off, they're doing so at a time when there are record levels of debt in the global system, which is obviously not good news. So I'm going to allow the speakers to begin without any further ado. Paul Sheard will assess the situation in the United States and where it's at now, and also look to some extent at the global situation. Shirakawa-san will stay closer to home and focus here on Japan here, and Jesper will look at the impact of inflation on business and industry and on financial markets. So, Paul, if you could lead off, please.
Thank you very much, Anthony. With pleasure. It's great to be back. As you said, quite a lot of water has flowed under the bridge since we last convened in December of last year. And so I looked back at, had a handout then. I kind of had a little look at that and to sort of mark myself to market. I think in December, I probably came across as fairly sanguine about the inflation outlook, and I would still kind of put myself broadly in that category, but things have changed, and I'll sort of come to the things that that are important there in a moment. But the sanguine part of me, really is a number of things. It is that I think most of what we've seen with inflation, and now of course we have the CPI, in the US for February at 7.9% year on year, which is really an eye-popping number. By the way, I think when we convened in December, that was 6.2%. So, people sort of like myself, I'll put myself in the camp, who sort of argued throughout 2021 in particular that, in some sense, this high inflation that we're seeing is not high inflation that has kind of got out of control. The genie's out of the bottle. Inflation and inflation expectations have been embedded in the economy like the bad old days, say the 1970s or the late 1960s or early 1980s. But rather, this high inflation that we're observing, starting in the US and then spreading to the UK, the Euro area, not so much to Japan, but other countries, is really mainly, very much the result of this incredible shock, this economic shock from COVID-19. But I think, many of us, and again, I would mea culpa here, throughout 2020 and 2021 really failed to understand, and we still don't fully understand, just what an incredible shock to supply and to demand this was, and the sort of complications, if you like, associated with the interaction of supply and demand. And, big picture here, what I would say is that when COVID hit in 2020, from around about March, in the second quarter, GDP and economic activity collapsed. And it was basically because the economy was shut down and, demand disappeared because of the pandemic, and then supply went with it. People didn't have the jobs because the demand wasn't there because of COVID. But then as the economy recovered over the next sort of year to year and a half, what we didn't quite realize was that supply had been really damaged or scrambled. And whereas demand came back very quickly, pent up demand kind of story. If you've got the money and you're now let out of your cave, you go back to the restaurants, you go back, you start traveling, you start consuming. But the labor market in particular had been heavily disrupted. And we see this in the numbers now today. Probably the most startling figure is the unemployment rate in the US is now down to 3.8%. It peaked in COVID at 14.7. It's not quite down to its all-time low, but it's getting awfully close. And yet job offers and job openings are around about 11.4 million. Well, how much is that? That's about 4.5 million jobs available that, higher than the run rate pre-COVID. And that just doesn't seem to be coming down. Meanwhile, depending on which number you look at, 1.5 to 3 million workers seem to be missing from the labor market. So, there's too much money being printed story causing the inflation. I didn't really buy that story per se. I think it is much more the disruption to the economy that COVID caused. And, in some sense, I don't blame the central banks and the fiscal authorities for pumping all this money into the economy to keep it in a kind of suspended animation, to keep balance sheets whole, and to be able to emerge on the other side of the pandemic, everybody in pretty good shape. Well, everyone's in good shape on the demand side, but not on the supply side. Central banks usually look through so-called supply shocks, but up to a point. At the end of the day, it's supply and demand are like a pair of scissors. It doesn't really matter which one is causing the inflation. If the inflation's picking up and runs the risk of starting to become embedded, then central banks have to move, and they are starting to do that. One thing that I've sort of, I guess, my thinking has evolved. What I was saying through 20 and 21 is, I think the inflation will be, transitory, but it'll take a while to work through the system. But if it's not, you can sleep easy at night because central banks, and let's just talk about the Fed, maybe focus on the Fed, its job is to control inflation. It has the tools to do so. It has the political independence. It will do that. That's its job. It gets up in the morning and it worries about, is inflation too high or is it too low? And it responds accordingly. And so, I've been sort of pretty confident that would happen. But I have to say that I do think the Fed has let this genie get out of the bottle a little bit too much. And, the Fed moved in March, made the first interest rate hike from 25 basis points to 50 basis points. But it's only just started, or only just stopped expanding its balance sheet. It had been tapering away its quantitative easing, but right up until the beginning of March, it was still expanding its balance sheet. That's quantitative easing. It's called easing. Why was the Fed continuing to ease monetary policy when we had inflation running 4, 5, 6, 7, now almost 8%, and likewise for inflation, for interest rates? I myself, would have been inclined maybe early this year or at the end of last year to have maybe raised interest rates by 50 basis points or so, just as a warning shot across the bow that we're here. Don't start thinking the Fed can't control inflation. Don't start thinking the Fed has become a weak institution beholden to the administration. No, we have one job, we're doing it. Speaking of the Fed, and I don't want to beat up on the Fed, but just to give you an indication of how much of a surprise this inflation has been to the Fed. The Fed comes out with forecasts of inflation, GDP, and also where it sees monetary policy going, the federal funds rate, over the next few years, every quarter. And if you go back to December 2020, when the Fed was forecasting what would inflation be, say, a year later, they were forecasting it would be 1.8%. So 2021, coming into the year, they were looking for 1.8% inflation, below their target. So obviously requiring them to have a very aggressive monetary policy, because don't forget, the Fed started to mimic the Bank of Japan in a way and introduce this kind of overshoot idea, commitment back in August 2020. So they were looking for inflation to be more like 2.2, 2.3, and then they'd start to move. So what did inflation end up being in 2021 in the fourth quarter? 5.5%. So a year ago, they forecast, or a bit more than a year ago, 1.8. It ended up 5.5. Now, again, not beating up on the Fed here. A lot of people got this wrong. I got it wrong. I won't speak for anybody else on the panel, but that's a huge inflation forecast miss. Well, what about more recently? Well, if we look at the forecast for this year for the Fed, in December, they were forecasting for 2022 inflation, it to be 2.6%. So they'd already factored in it was going to be well above target, but not completely panic territory, but 2.6% is not 2%. Now, 3 months later, the latest forecast update, they're looking at 4.3% by the end of the year. So they've upped their forecast for inflation for this year in just 3 months by 1.7 percentage points. That's almost the whole inflation target. So again, it just gives you an indication of how difficult this environment is proving to be for forecasters. But the Fed is a particular forecaster that has to manage the economy and manage inflation as well as forecast it. So against that backdrop of how consistently the Fed got its inflation forecasts wrong, the way in which it's been so slow to move and somewhat timid in moving, I think is I would be critical of that. Just on the Fed outlook, what are they signaling now? Well, with their March meeting, they moved up 25 basis points. They signaled that they were going to hike another 150 basis points this year, another 100 basis points next year. That could come in 25 basis point doses. I think you will see 1 or 2 50 basis points in there as well, maybe. But that's 250, or adding the one we just had, 2.75 percentage points worth of interest rate hikes they're forecasting over the next 2 years. Is that going to be enough to start to restrain the economy and pull it in? Who knows? It depends what happens to the economy. It may fall in a tank from other reasons. But the point is, the Fed, I think, is making the right noises. On the balance sheet, although I just criticized them for continuing to expand it, they are now signaling at their next meeting, which will be early May, almost certainly they will start to let the balance sheet run off. And they'll probably just copy their playbook from October 2017, when they tried this last time. They didn't get very far, I have to say. And of course, they have a much, much bigger balance sheet now, almost $9 trillion. Where would it be without any QE over the years? Probably more like 2.5, 3 trillion-ish territory. So they, if you like, $6 trillion of QE sitting on their balance sheet that they could, put back into the market, into the treasury market, if they so desired. And that's a monetary tightening tool they have up their sleeve. And they have, of course, infinite interest rate tightening capacity. So I'm not too concerned about the, we always worried in Japan with the deflation in Japan with quantitative easing. And then, of course, we had the global financial crisis. The perennial sort of central bank watching concern was, are the central banks running out of ammunition? But they don't have that ammunition problem on the reverse side when they're trying to tighten financial conditions, because as Volcker showed us, you can hike the interest rate quite high. Now, the other big thing, and you mentioned it, and I'll stop here because I see the clock is ticking faster than I expected, is the Russia-Ukraine shock. And the point I would make here, just stepping back, is what we've, when they write the history books, the history books will show that we had two, and we don't know how exactly what's going to happen with this second shock. I mean, it could get, very, very nasty in terms of military action. I mean, we just don't know where we are. I shudder when I hear people talking about battlefield nuclear tactical weapons and potential to be in a World War III. So, we might be sitting here in 3 months' time or 6 months' time with a very, very different sort of geopolitical backdrop. But even if everything kind of settles down, a lot of the world is going to be a very different place, because we do seem to finally have this major decoupling taking place. And, China is so far, at least, very much, on the Russian side of the fence. Anybody who wants to get a better geopolitical sense of that, I would suggest they read the February 4th statement, about 6,000 words long, that came out from China and Russia at the occasion of the beginning of the Olympics. And it really sets out a view of the world, the geopolitical world. And the geopolitical world ultimately means the geo-economic world, which is very important to take note of. So tectonic plates are shifting in the world, which are going to have effects that we don't fully appreciate. So obviously, oil prices, pressure on oil prices to go up. Nord Stream 2, it's not going to happen, or the gas is not going to flow through Nord Stream 2. Oil sanctions, again, Russian energy sanctions in the US. They may come to Europe as well. So the energy markets are obviously being hit with a shock. But also, I think supply chains, we're going to hear more about supply chain disruptions, like as we did with COVID. So I look at this Russian-Ukraine situation, still a lot of geopolitical risk, but also it looks like one of these, another shock, both to supply and to demand, that it's very difficult, to know exactly how both of those shocks are going to play through the system. So one shock after another, and the starting point from an inflation point of view and from a central bank policy management point of view for the second shock is very, very bad. One shock that takes you from below target inflation to above target inflation is one thing, but something that ramps you up further from there is going to be much, much more difficult for the Fed and other central banks to handle. So let me just leave it there. I'm very interested to hear particularly both Jesper and Shirakawa-san's comments, because as in previous episodes, Japan seems to be the odd man out. If I look at the numbers correctly, I think the core food and energy is actually still in negative territory. The headline inflation is a tiny bit positive, 0.6 or something like that. But we haven't seen this shock so far solve the Japan deflation or disinflation problem. So I'm all ears to hear Shirakawa-san now.
Thank you, Paul. Some very sobering thoughts, if I may say so. Shirakawa-san, please.
All right. Good morning, everybody, and thank you for inviting me again as a speaker, panelist. So let me confine myself to Japan's situation. I believe Jesper is talking about more broad picture, global inflation, business kind of implications. For Japan, I think as a starting point, I would like to stress that the household behavior, in particular, how Japanese households responded to inflationary shock, or after COVID sort of stabilized economic situation. And of course, the savings rate behavior would be most focused. And as we do not have monthly basis savings rate from SNA statistics of Japan, as a proxy, we look at the sort of financial surplus to disposable income ratio of only workers' households. So excluding pensioners' behavior, pensioners, of course, the savings rate tend to be negative depending on the age group. So that's why the number itself is very high because only capturing workers' households. The spike of the savings rate was from the government cash payout, and some decline, last year when the COVID-19 new cases declined, and slide up again because of the Omicron-related, bit of restrictions by the government. So now the question is it going down back to trend, which means the consumption will be very strong in Japan, and that will be leading to more demand pull type of inflation in the second half of the year, and that would change the Bank of Japan's stance, in our view. But an interesting thing is the Japanese households tend to save more if inflation expectations pick up. So, people tend to say, okay, Japan's problem is in a deflation expectation. That's why people save money. In one sense, maybe true, but the history tells you that if Japanese household expects higher inflation rate into the future, they tend to save money. There was a sort of this red dotted line is CPI headline. And actually, if you take a look at VAT hike in 14, CPI picked up, right? And then flattish and another VAT hike, but that didn't impact much CPI. And households, savings behavior is strangely, of course, at the time of the VAT hike, savings rate declined. It's kind of forced to spend money because of the VAT hike. But then, since then, expectation for inflation by many Japanese households are actually, in one sense, deteriorated. So many people tend to expect, okay, more VAT hike could come, and prices may go up, and then savings rate started to pick up. I didn't show the data before 13, but there has been kind of decline, but then started to pick up from here. So we tend to think that inflation expectation is not necessarily demand stimulating, possibly savings stimulating. So this is the one thing. And secondly, as a kind of GDP gap kind of story, we had a shock on the real consumption from the COVID-19 pandemic. And if I take this is a kind of real household consumption excluding imputed rent and trillion yen basis. So before the VAT hike in Q4 19 and before the pandemic, it was roughly speaking 247 down to 220, 210, going back into like 230, but still the huge gap from here. And if you take a look at the trend, it has to be going up, but there remains a huge negative output gap or demand supply gap in consumers market. So we tend to think that the household behavior is still a bit uncertain, but not necessarily they become proactive in spending. Plus, from the viewpoint of the consumption-related sector businesses, they tend to feel that the gap is still big, and they are not necessarily so inclined to raise prices because that may even hurt their real sales number. And then the US is always talking about, okay, we had a big, unfilled job offers, where, as Paul already mentioned, significant tightening of the labor markets. And Japan's case is not necessarily an exception because the behavior of this is effective job offers and unemployed number, the gap. So if you take a look at the Lehman shock, the huge decline in effective job offers, and unemployed picked up, and the balance was actually, significant negative side. But then when the economy started to get better, this number is getting positive, and COVID shock was almost nothing compared with Lehman shock, and now started to pick up. Means labor market in Japan is definitely much tighter condition compared with the period after the Lehman shock, in the pandemic shock, after pandemic shock. And now you see slight, positive means there seem some unfilled job offers. And again, it is up to the dynamics of the consumption. And if the consumption starts to pick up hugely, as the saving consumption behavior of Japanese household changes, and then we're going to see a significant, I think, tightening of labor markets from here, and then more wage pressure. But again, the question is this: I mean, the gap is big, so businesses will probably scratching their head because number one, import inflation pressure, but consumers not necessarily so prepared to take higher prices, possibly, but plus they're probably facing difficulty in hiring people. So what they're going to do, the issue. Well, this is just to add the wage story or the job market story. This is a labor cost. This is a very simple nominal employee compensation divided by real GDP. It's a kind of the volatile number year by year. But as a trend, we're still on the rising trend starting around 2010. So COVID shock was not changed the unit labor cost trend, and we tend to think that it is. I think if this situation, the job market tightness continues, labor cost would be gradually picking up, and then the question is how businesses can toss their cost increases to final prices is totally up to the Japanese consumers' behavior. And Japanese consumers are now looking at the fairly high one-year expected inflation rate. So back to the very first slide, I think the point is, okay, Japanese households are now expecting, this is, I think, corrugated from the consumer survey, with some assumption. So what is the average of expected one-year inflation rates of the average households? We had an energy food price hikes like 2008, VAT hike in 14 and 19. And now, again, going up to like 3.5% number. So again, the question is Japanese or are Japanese people started to even, let's say, reduce the spending to be prepared for further, price increases, expected declining savings in the future, or are they starting to spend money? And that's a question. And the CPI is right now, I think, because of this huge distortion from the mobile phone charge declines, under decided, under, Suga administration. And if you take a look at this, definitely the telecommunication side is pushing down CPI, roughly speaking, 1.5%. So huge decline, and that would be disappearing in April. So many are saying, okay, if this trend of the high energy prices and high energy prices continues, if the base effect is gone, Japan CPI as a headline right now 0.6% would easily touch 2% in Q4. So everybody knows that, right? And because of the Ukraine-Russian war, I think the commodity prices have picked up further. So it is quite reasonable to assume energy price contribution and positive contribution to CPI to widen somewhat. But a big question is food prices. And in our analysis, the Japanese tended to behave in a way to reduce real food consumption if food prices pick up. Energy prices pick up, and that relative price changes will not necessarily change the demand for energy. So energy consumption of Japanese is much, much less sensitive to price changes, for energy, but for food consumption, it is more sensitive to price increases. So what we would expect is that, okay, wheat prices will pick up and bread prices will pick up and more imported food prices will pick up. And now the food companies are preparing for raising prices in April. But if they do too much, consumers will probably react in a way to reduce food consumption in real terms more than price increases, possibly. So what they would do, food price companies would do would be the same price, lower portion, or some lower quality ingredients maybe. So I always say that the tofu in the past, I think the kind of big tofu is like 100 yen. Now the very small tofu is 100 yen. And the point is, CPI is not necessarily well designed to track such a kind of the real inflation. So if you work for the MIC, the CPI is in a mystery, and you have to go to supermarkets, or you have to make a call to supermarket and say, okay, what is your price right now for one tofu, and same brand and same green ingredients and how much, kind of thing. It's very difficult to answer, right? So what would happen is we're gonna eat less and less portions, same price. It's actually inflation, but CPI is not necessarily picking up. But again, so in that sense, finally I talk about, sorry, I didn't put any BOJ thing, but I think the point is we know that in Q2, CPI will be very close to 2% or around 2%, and possibly, touching 2.4, 2.5 temporarily, depending on the commodity price dynamics from here. But the BOJ knows that there's such a kind of, consumers' behavior, as I pointed out. So, fairly restraining behavior of consumers to food price increases, or the, generally speaking, inflation shock like VAT hike is leading to higher savings rate kind of thing. And also they know that GDP gap or consumers market gap, demand supply gap is still very much on the negative side. So Kuroda-san is so stubborn, not changing the monetary policy. The question is that sustainable? Because if you take at the Japanese yen market, 122, 125 is possible. They don't do, anything forever, or they'll be forced to do something to put some of, to ease the upward pressure on the dollar or the downward pressure on the yen. Our answer is that it is possible for the Bank of Japan to tweak 10-year interest rate target, YCC, like the upper side, corridor is 0.25% right now, and every day people are watching whether or not BOJ is trying to intervene in the markets to buy JGB on a limited amount and put a cap on 25 beeps, or they're going to stop doing that. But our view is that unless they do see, unless the Bank of Japan confirms that demand of consumers really picking up and adding to a inflation pressure, unless they do confirm such a kind of situation is happening, they will not change the policy. And the problem of that is they will wait for longer, yen could be weaker, import inflation would be bigger, and less and less chance for consumers to become aggressive or proactive in consumption. So Bank of Japan seems to be, right now, inviting some or more important inflation pressure, inflation tax, and the consumer cannot be so proactive. And finally, inflation goes down. So that kind of scenario is now BOJ is embracing in my view. But the risk is that the market could be very shaky, yen could be shaky, JB market could be shaky, and I think I don't know. I mean, that is not necessarily good for a financial markets, but that is the current situation, and our reading of that. I stop here. Thank you very much.
Thank you very much. Very interesting comment coming from a former Bank of Japan official. The Bank of Japan is courting inflation, but we'll come back to that, I'm sure, in question time. Jesper, if you would.
Great, fantastic, and Paul and Shirakawa-san, I mean, thank you very much for this, very, very good overview. I must say, I love, Shirakawa-san's analysis that because of inflation, we're all going to go on a diet. So, maybe that's, one of the key things here. I wanted to just sort of, raise a couple of points here, sort of connecting, some of Paul's comments and Shirakawa-san's comments with my own thoughts here. And, the first comment is that, we've got to remember a little bit of the genesis of where we're coming from. We've had various shocks to the global economy before. We had the global financial crisis, and then, of course, we did have COVID. And all the time, the overarching policy priority was to not make Japan's mistake, to not be gradual, to not be behind the curve, but everybody was focused to counter these shocks with bazookas, with like shock and awe, very aggressive policy. And of course, monetary policy was the first. And then during the COVID shock, it wasn't just monetary policy, but it was also fiscal policy that actually came to the rescue, very, very quickly across the world. And even, to many people's surprise, even in the United States of America with all the income support and the employment support measures that were put into place there. So the overarching policy priority over the last decade was to make sure deflation never happens. Now that we're on the other end of the spectrum, I think it's very clear that it's asymmetric, in the sense of that nobody wants to bring out a bazooka to actually counter the writhing inflation threat. And that may very well be the wise approach, in the sense of that the shocks are transient, and as Paul pointed out, it's both a demand shock and a supply shock that is, keeps on, getting new challenges now with the Ukrainian situation. But from a policy perspective, it's probably not a bad thing to give capitalism a chance, in the sense of that if you do have supply chain disruptions, yes, that causes some short-term disruptions and pain, but it also forces rethinking of corporate strategies. And I do want to point out that we are seeing pretty much across the world records amount of, number one, business investment, capital investment, and we're also seeing records amounts of IPOs and corporate formation. So these disruptions, these challenges that are actually happening, the price signals that are being sent in the economy are actually unleashing animal spirits around the world. That doesn't mean that inflation is going to come down very quickly, but it does mean that the free market system of capitalism works. And I mean, you know the old quip, what is the cure for inflation? It's higher prices. Because if there are higher prices, then you and I may actually decide to set up a business to exploit exactly that opportunities. And so I think actually that the policymakers on the monetary side are actually quite right to not bring out a bazooka, to let things work out. The worry I have is that not from the monetary policy side, but from the regulatory and political side, that we are unleashing forces that actually force a structural upshift in global inflation. What are these forces? Well, think about some of the deflationary or disinflationary big forces that we had over the last 30 years, right? The first one obviously was the People's Republic of China entering the global economy, China becoming the factory of the world. And as a result of that, everything from diapers to paper cups to all sorts of things to electronic goods becoming cheaper and cheaper and cheaper because you had China allowed into the global economy, this is obviously now reversing. Because, whatever happens with the Russia-Ukraine situation, I think it's a fair guess that, the limits that the United States of America in particular wants to put on China's engagement, in the free economy, that these limits are not going to be coming down in the foreseeable future. The second structural force is, the IT and internet, revolution. Remember the IT revolution, the advance of the internet, the emergence of internet-based business models to do B2B or to do B2C was a huge disinflationary force. Well, that's changing in the sense of that now, prices for the internet are going up. And I sometimes actually quip that, we've gone from IT, which was free for you and I, the consumer, now we are going to AI. But the moment you add an AI into the service, you actually have to pay for it, right? Rather than it being free, what it used to be. Whether it actually helps or not, whether it actually boosts productivity is to be discussed. The third element, on top of the structural change vis-à-vis China, the structural change vis-à-vis the IT industry and technological progress, is ESG priorities. Greenflation is a very real factor, right? And there is, a good element, obviously, as a human being, in having clean air and clean rivers and all of this stuff, right? But there is an economic cost, and this transition of weaning yourself off carbon and going towards a non-carbon-based economy, the cost for that is something that consumers and businesses, will have to be paying. That's obviously something, where, the Ukraine threat, particular to my home country, Germany, is obviously sort of elevating, the urge of that. And then last but not least, I think that there is a general shift in the overall policy priority, and the Biden administration is actually sort of the vanguard of that, in the sense of that over the last 30 years, the policy priority was always on more competition is better. How do we judge that? We judge that by whether prices are going down. This is now changing towards a focus on equity, on, industrial structure, right? The whole debate about the monopolies and oligopolies in the United States and what is to be done about them, right? Again, does actually mean that potentially, if this policy persists, right, that the incentives for you and I as entrepreneurs, for you and I as investors, right, are actually being taxed in the sense of that, fine, if we have to pay for a fairer market rather than a winner-takes-all market, there are costs that are going to be associated with this. So the point I'm really trying to make is that, it's always important to have central banks. When I was in the day business of forecasting interest rates, I always loved the fact that we've got global central banks. We can always blame everything on them. But the reality is that the underlying political and policy priorities are actually changing, and in my personal opinion, they deserve much, much greater, attention coming forward. Now, in a couple of minutes, what about Japan? I think that Shirakawa-san laid out the situation extremely well. I would just add a couple of things. In my personal opinion, Japan is now entering an absolute sweet spot in the sense of that you've got no tangible, no significant increase in inflation. So as a result of that, the threat to the purchasing power of the Japanese people, the threat to the purchasing power of Japanese corporations is actually relatively limited. Of course, you've got food price increases. Of course, you've got energy price increases. So the terms of trade, are something that, put a little bit of cost push inflation into the overall system. But in aggregate, I think that the sweet spot that the Japanese economy is in is very, very good. There's no inflation. Last but not least, the yen weakness in my selfish world of financial forecasting, yen weakness is a boon for the listed companies because basically 2/3 of their revenues come from the rest of the world. And as the yen weakens, for every 10 yen of yen weakness, EPS, earnings per share in the Japanese equity market, get a windfall gain of between 8 and 9 percentage points. So that's a definite boon that you actually have. And then last but not least, like I mentioned before, the supply chain disruptions that are going on in the world are excellent news for a country like Japan that is a capital goods maker. Japan makes the machines that are building the new factories, that are building the new distribution hubs, that are actually, the rebuilding of the supply chain that is actually going on. And then last but not least, I would also add, that actually Japan does have a government that actually works. They've got basically a 2/3 supermajority in parliament. Prime Minister Kishida is a Machiavellian person. He's got an election, an upper house election in July this year, and everybody and their brother who spends time with him is advising him to add another 2 to 3% of GDP of fiscal spending to actually support the demand loss that we get in the private sector from cost push inflation. So I think that the disruption in domestic demand from higher prices, which is a real risk in Europe, which is a real risk in the United States, I think in Japan is relatively little. So from my perspective, I think that Japan actually is in a sweet spot from that perspective. One final point I wanted to make, Shirakawa-san mentioned briefly the Japanese currency. It is very interesting that, for once, economic textbooks actually work. You've got rising interest rate differentials with interest rates in America going up, Japanese interest rates staying put. That pulls the yen lower. On top of that, you've got a trade and current account surplus that has been declining because of rising input costs. As a result of that, any first-year economic students would now forecast a weaker currency. Personally, I'm actually quite interested that nobody's prepared to actually make a bigger call. I personally think that an overshoot towards 135, 140 is perfectly possible. And that's the final point I wanted to make. A strong dollar is now very much in the interest of the United States of America, because a strong dollar lowers the inflation pressures that American consumers actually have. So I think that in 1998, it was Bob Rubin, Treasury Secretary at the time, standing in front of a CNN camera, when dollar yen was at 140, 142, saying a strong dollar is no longer in the interest of America, and the dollar crashed, the yen appreciated massively. I think for all intents and purposes, right now, given the inflation dynamics in the United States of America in particular, anything you can do to have lower import costs is going to be welcomed by US Treasury and Federal Reserve officials. So in my personal book, if I had to make an outside bet this year, it would be two things. The first one, dollar yen going to 145. And the second one, Germany winning the World Cup in the soccer championship later this year. Thank you very much.
Okay, thank you very much. Your forecast about Germany winning the World Cup is going to make headlines, I'm sure. Okay, do we have any questions from the floor, from people here? Any online? Not yet. I'd like to bring us back to the question of the yen, which two of the speakers have spoken to. Obviously, it has advantages. The weaker yen has advantages for the corporate sector in Japan, but two things. What are the disadvantages? I mean, their import costs will rise, and some of that will be reflected in energy costs and food costs imports. So what is the downside to the weaker yen? Can I ask maybe Shirakawa-san, do you want to say something about that first?
Well, I think the yen's weakness, is impacting, in particular in short period of time, I think impacting import prices more and taking some time for exports price to pick up. But I think net, I think the slightly negative in terms of the impact on terms of trade. And the question is, what is happening to real exports, real imports? And the point is that we are currently seeing the less and less positive impact on real exports from the depreciation of the currency. But in the meantime, real imports are not necessarily declining even if the yen weakens. So slight decline in terms of trade on net basis from yen's weakness. But we are more worried about the situation where Japan's real imports, real exports situation, which is the real imports may continue to be elevated if consumption in Japan is strong, but real exports are not necessarily so picking up. So it means we have very strong conviction that weaker yen in the current situation is leading to more deterioration of trade balance. In the meantime, the income surplus would be okay as long as global markets remain stable. And also, we're going to see pick up interest rates levels, means income surplus of Japan would be gradually picking up. So it means on balance, the trade balance would be under pressure, but as an income balance would be enjoying weaker currency. So net, not necessarily huge impact on current account balance from yen's changes. But again, my sense is that yen's weakness is not necessarily a good thing for Japan in terms of the national security perspectives. I'm a bit more on the conservative side, but if this yen weakness continues, Japanese companies, market value would continue to go down. And many other countries are now looking at Japan. Okay, Japanese companies very cheap, stock price is not necessarily so high, and yen is cheap. I'm a bit worried. So from the security perspectives, I'm not so comfortable with currency weakness, even if this currency weakness seems to be reflecting a bit of a more structural problems of Japan. And I tend to agree with Jesper that the 140 is not necessarily a so remote number, because we saw that in 1997, 1998. But I think that time we had a financial crisis in Japan. 140 may be a bit too much, but I think I tend to think that 130 is possible.
Can you just quickly elaborate a bit on what you mean by the security implications? Are you implying that foreign companies may start taking over Japanese companies en masse? Yes, just
can I add something to that? And this is to me sort of a forward-looking key question is whether Japan is going to open its borders for tourism again. Because obviously, you know, with the yen, you know, the purchasing power of, you know, whether you're European, whether you're American, whether you're wherever, you know, at 120, 125, if I'm right, you go to 140, 145. I mean, this would be a huge boon, you know, for the tourist industry, for the Japanese hinterland. You could really get the Japanese service companies, right? You know, actually a boost coming through. So I think in terms of forecasting the current account dynamics, the balance of payments dynamic, Shirakawa is spot on. You know, but the added, I think the big unknown, which would be a big swing factor, you know, if and when the borders get opened again, you know, the current account situation is going to change very quickly in Japan's favor.
Yeah, services exports would benefit. Yeah, you're right. Tourism.
okay. Paul, do you want to add anything on that? Any thoughts?
No, I think I think
Paul, is a strong dollar in America's interest?
well, I think it. I don't know. I never quite like. I don't be too pedantic, but this sort of, you know, strong dollar, weak dollar, strong yen, strong dollar. This is like a boy that is moving around the ocean and is being buffeted by different cross currents. And you know, the whole premise of sort of modern day economic management, international monetary system is we operate with flexible exchange rates. And so the exchange rate is, you know, is part of that market dynamic. It's kind of that you were talking about, Jesper. So I don't kind of pay too much attention to exchange rates. They will move where they kind of need to move. They'll overshoot, they'll undershoot. But, you know, from a pure economic point of view, as you said, the stronger dollar would certainly help curb some of the, you know, some of the inflation. But it's part of the whole economic adjustment mechanism. So I've never spent a lot of time kind of, you know, worrying too much about it. I do chuckle as I listen to the conversation, again, for people who've been in the markets like all of us for a long time. I remember the yen at 145. You know, it's what, 122, 123 now. I could easily see it, you know, particularly if the Fed ends up having to hike interest rates more, starts to be a little bit more aggressive with its balance sheet unwind. Long-term yields move up more, 130, 140, 145. You know, the game is on. I do, but just big picture. I mean, Shirakawa-san mentioned the national security implications. Again, I wasn't quite sure what he meant. Thanks for clarifying that with your question, Anthony. But you know, again, a weaker yen or a weaker currency, it means you have, you know, you're competitive. You're more competitive for the reasons that have been stated. But you know, your purchasing power in the global economy, your ability to command resources is eroded. And, you know, so I'm always a little bit, we tend in the markets often, oh, weaker yen, good for the exporters, good for the stock market. But when you step back from it, you know, it's making your purchasing power. So I thought national security maybe in that aspect, just the weight of your economic power of the global economy, you know, is affected by that.
Yeah. I guess the days when the US Treasury or even the G7 would intervene and say the yen is too weak are over, are they? Paul?
Well, we haven't seen that. Yeah, I mean, for all intents and purposes for the time being, but you know, everything, I mean, we're in a very different world now. I mean, you know, you've been writing recently in, you know, one of your reports, Anthony, about the, you know, some of the implications of this latest Ukrainian issue with freezing of it's perhaps less freezing than meets the eye, but freezing of the central bank reserves of the Russian central bank. Some questions are being raised about what's happening to, the dollar as a reserve currency. That kind of plays into this. And as I was listening to the conversation, again, I was thinking, yen's weakening for the moment, and there are good monetary policy reasons for that. But, could at some point, depending on how these things play out, we see flight to safety, or the idea of the yen being not the reserve currency, but perhaps having a little bit more oomph and presence as one of 4 or 5 reserve currencies in the world. Maybe the yen can make a little bit of a comeback from that perspective.
Okay. Any questions? Yeah, Kurt, please. Can you go to the microphone as usual?
Yeah, my name is Kurt Sieber. I'm an associate member. I think this year is an excellent opportunity to talk about the 100th anniversary of the Weimar Republic.
Sorry, could you hold the microphone?
It's just 100 years now. And that always calls back to my grandmother, who gave me or fed all these details from that time. I think the situation is greatly different from that time, but
Kurt, sorry,
there are some, there are some parallels. Yeah, no, but well, first I would like to say this is the best meeting we ever had. It was absolutely fantastic for people outside, because it is also understandable for if you're not an absolute specialist in exchange rates and so on. But my question here is, 145 still looks like pretty much a shock for many people. But my question is, well, okay, cheap Japanese companies to buy. That is absolutely true. But what are the other factors for foreign companies to really come to Japan, seeing that the Japanese companies, they're all going abroad. We were talking about 2/3 or 1/3 coming from outside. I recently attended a meeting. The president said 7% of their income is coming from Japan, and the 93% from outside. And they're paying the bonus in Japan based on the profit they are getting abroad. So what are the other factors which what Japan needs very much is to get additional work here in Japan. And what can we do, or what can Japan do? Opening the borders has been the key point during the last 6 months. And so with some very limited, but with some. So how about, what are the attractions for foreign companies to come to Japan? Thank you.
Okay, Jesper, you'd probably take that first, if you would.
Look, the attractions are the same that they've always been, in the sense of that, you're dealing, with still the 3rd largest economy, with one of the highest purchasing powers, in the world, and you're dealing with a very homogeneous market, right? As you know, if you do make it in here, yes, it's not easy to do business here. But once you're in, you make very, very good money. The second factor is that, yes, as you point out, Japan is now cheap. Even with dollar-yen at 115, 120, if I have to hire a software engineer, he or she in Tokyo is now about 15 to 20% cheaper than in Hanoi. And that's incredible, right? So Japan has actually priced itself back into the market. And then last but not least, for an American company, I think this is where it gets very interesting because yes, the last 20 years have been boom time, boom time, boom time in America, but America is very saturated, right? And very, very plowed out. And so I was very interested in seeing last year, a company like PayPal, a fintech innovator, right, which is huge, right, globally, actually making a $2.3 billion acquisition here, buying Paydi, a Tokyo-based startup. Right? So it's very, very interesting, that you do see these reverse flows because yes, thank you, America has become expensive, and yes, thank you, Japan is cheap. At the same time, I think, whether it's corporate governance, whether it's the way of doing business, whether it's the way of being able to get a bank loan, whether it's the way to get equity financing, et cetera, yes, it's not America, but, there is no question that the improvement in corporate governance, the improvement in the, in the way business is being done here, and the strong standout that, yes, Japan is not the Wild West. Japan does apply the rule of law, right? And, that's something that some people don't like, right? Because they love to operate inside the Wild West or inside their own little cliques, right? But in Japan, if you want to come in, you can come in, but you got to play by the rules. And that, certainly, I think, for anybody who does IP, intellectual property intensive business, right? If you and I, set up, a company that depends on intellectual property, whether it is in healthcare, whether it is in robotics, whether it is in AI, the intellectual property I develop in Japan is basically 100% protected. You cannot say that for any other Asian country with the possible exception of Singapore.
Okay. I see we've got several people come in online. Does anyone wish to ask a question online, especially given controversial suggestions that the yen is going to go to 145 to the dollar, if not later? I'd like to come back to markets, if I may, the impact on markets. I mean, Jesper said that none of the monetary authorities have used a big bazooka yet. That's true, of course. And of course, there are structural factors at work and so on. But in the short term, we're going to see, significant further increases in interest rates. We have still markets at very high levels. We have all kinds of uncertainties. So, and not to mention huge debt in the system. So, what is the danger of a short term? Well, I'm going to go to an extreme and say a market crash, a stock market crash, for instance, given the extreme uncertainty at the moment and the outlook for inflation. Paul, let's take you on that first.
Yeah, it's a brave person who forecasts market crashes, but on the monetary policy side, I mean, one of the obvious triggers for that is is monetary tightening. And, I always make the point that I made it again today, that it's sort of in principle easier for a central bank to fight high inflation. You just restrain the economy. You've got interest rates, you've got your balance sheet these days as well. Whereas in the other direction, trying to get close to the zero bound, monetary policy is less effective. Monetary and fiscal policy usually not that well coordinated, and you can get into the sort of the Japan style trap, deflation trap, etc. So in principle, this is a much kind of a better place. But Jesper mentioned the asymmetry of the bazooka, and I think that's kind of right, because you see time and time again that in a financial crisis or in a major stress point, central banks can cut very far, very fast. And, we saw this in the financial crisis. The federal funds rate in August, September 2007 was 5.25%. 15 months later, it was 0 to 25 basis points. So they cut 500 basis points in, a year and a bit. And sometimes you had inter-meeting movements and you'd get 50 basis points, 75 basis points. And we saw the same thing with COVID, where in the first, basically 2 or 3 weeks in March, the Fed went from 1.5% down to close to 0. Again, just like bang, bang, bang. You don't see that in the other direction. You see this much more, this incrementalism. And, the sort of funny thing there is that we're always taught, speaking of the textbooks, that monetary policy works with long and variable lags. So if that's the case, and the economy recovers faster than you expected, and inflation comes back and goes, as I said, nobody ever expected, PCE of 6.5%, I think it is now. It's supposed to be 2%. So if the Fed is going to sort of go slowly and gently, and as I said before, up until recently, it was even expanding its balance sheet in this environment, there is this danger that they sort of do get behind the curve. But of course, central banks do not stay behind the curve forever, because if it finally does turn out that the penny drops, then they have to tighten quickly. And again, because of the lags in monetary policy, it's very easy to kind of overdo it. And the other thing that, again, bears repeating is that monetary policy does and is supposed to work through financial conditions. We invest the central banks with almost a kind of omnipotence, that they've got these tools and they're focused on the economy and they'll turn the knobs when they need to, but they only control monetary policy to the front door. From the front door, the markets take over. And that's why you can get these crashes. So they're very hard to predict, because it depends on herding and investor sentiment and all these sorts of things. But definitely, given the objective conditions, that financial markets have performed very, very well. Even with this inflation, CPI at 7.9%, 10-year treasury yields have only moved up to 2.5, 2.15, 2.2% kind of territory. Looked at it today, that's like ridiculously negative real interest rate. But even over a 10-year view, it implies that 10-year treasuries are only just slightly positive, rather than being 1 or 2% positive. So yes, I mean, difficult to predict. I wouldn't want to do that, but again, with all these geopolitical issues brewing, and geopolitical issues, just to comment on that, it always seems to be the case, I think, that geopolitical issues have an outsized impact on sort of the attention, the media. They garner a lot of attention, and markets just seem to sail along. And if anything, they can be positive, because they usually indicate some, depending on what the event is, there may be some increased expenditure. Or, as we've seen, perhaps until recently, the geopolitical tensions cause the central banks in particular to be a little bit more cautious with their tightening, and markets like that as well. However, again, all of these things can suddenly catch up with you. And so, yes, there are certainly some fragilities in the financial markets. But doesn't mean that they're by any means inevitable that we're going to have a crash.
Shirakawa-san, prospects for a shock in the Japanese financial markets?
Well, I think the big question is on the sustainability of YCC framework of the BOJ. So if they do want to cap at 0.25% for 10-year interest rates for long, I think the more and more pressure from the markets means BOJ will be forced to even increase their balance sheet further. So it's kind of pouring fuel into frames. So that means somewhere at some point will not be sustainable. BOJ will give up YCC. For example, if a yen is 140, for example, I think it is almost impossible. In that situation, US interest rate should be much higher from current level. And if the BOJ, is forced to again put the cap on interest rates, BOJ continue to buy JGBs more aggressively, and yen would weaken further, and that system will be collapsing. My very strong belief is that the nominal long-term interest rates of risk-free, I don't know if Japanese is really risk-free, but risk-free rate is really important for equity markets. So I do not want to say that the Japanese equity market will collapse. However, the very shaky markets will be quite possible, mainly because of sustainability of the OICC, and interest rate may spike and uncontrollable, like 0.5, 0.6, or even 1% for 10-year. It is almost impossible for Nikkei to stay current level, in our understanding. So it's a very risky situation right now for the bureaus of YCC, and they hope that the Japanese economy will not pick up. If Japanese economy growth is really low, imports is low, remain low, it will be okay. So as my experience being the central bank official or kind of bureaucrat, if I am the Minister of Finance official, BOJ official, what I would like to say is that you should be prepared for the deterioration of your real purchasing power. You should save money. Don't spend money. Don't make sort of the revenge consumption, what we call. You should stay at home and be quiet and let the market stable. You should not behave like spending money. You should not stimulate in imports and so forth. So I will make a continuously kind of negative message to people that economy will not be so good, like Kuroda-san. And I mean, if you're hearing to him, he's not expecting economy is really picking up. He seems to be seeing kind of a downside risk to the economy, right? So it's kind of bureaucratic way of thinking, but I'll tend to agree with him because I think currently it's kind of critical moment for Japan. So I try to make people stay at home, not going out. I stop here.
God, Shirakawa-san, so we're going on a diet and we're staying at home.
Yes, to keep the market stable.
Sounds like a permanent lockdown.
Look, it's very interesting, and I mean, you can Anthony, to your question, will there be a 10-15% downdraft in global equity markets at some point over the next 9 months? I think the answer, the probability of that is very high, just by historical precedent, right? The key question, however, is the following, and I alluded to that the structural inflation drivers that we have are the change in political and policy priorities vis-a-vis China being locked out of the global economy, vis-a-vis IT, the lack of real incremental progress now, ESG, the Greenflation issue, as well as the policy priorities, focusing on equity and market structure rather than just on lower prices good. Against that, central banks effectively, and the BOJ may be a little bit of an exception here, we had Paul Volcker, whose determined policy priority was to crush inflation come hell or high water. And he did that with incredible pain because for those of us who are old enough, America in the first part of the 1980s wasn't a lot of fun, to be with. But he did get inflation down. Since then, we effectively have the Alan Greenspan philosophy, which people in markets refer to as the Greenspan put. Right. And, take your place. If the market does go down by pick a number, there's nothing precise about it, 25, 30%, you will get a change in monetary conditions engendered by the by the Federal Reserve stepping towards an ease, right? In my day job, talking to the masters of the universe in global finance, there is plenty of them who are prepared to bet that the Federal Reserve is in fact already beginning to make a mistake. In other words, that it's too late, right, to do anything, and that the real issue is inflation in America, in particular, actually forcing a prolonged recession because of the reduced purchasing power coming through. As a hint, What do you do if you want to see what markets are looking for? Have a look at the shape of the yield curve, right? So that's the difference between the policy rate, short-term interest rates, and long-term interest rates. And what you will have noticed that actually, still early days, the global investors or the US long-term interest rates are not increasing. Right? And I would be, as a risk scenario, I would be prepared to make a bet that, in 4 or 5 months, you actually have an inverted yield curve. In other words, where you've got long-term interest rates below, short-term interest rates. And that, of course, puts the squeeze on the financial system. It's no longer easy for banks to make money because they've fund themselves short-term, they lend out long-term. That's something that I think as a next inflection point, right, in terms of financial markets, look at the US yield curve and see whether the curve actually, steepens out or whether it actually inverts. If it inverts, I think that yes, you'll get a crash in US equities led by US financials.
Okay. Let me put forward the Rowley theorem, which you can shoot down because you're experts and I'm not. But is it that stocks are not so sensitive to the cost of money as to the quantity of money, i.e. central banks have not really begun in earnest yet withdrawing money, for cutting their balance sheets. But as they do, as they're going to, could that be a trigger for the stock market to correct sharply? Paul?
Well, it could be, and just going on from that point of Jesper's, if you do that, I actually got the 10-year Treasury yield wrong. I think it's actually 2.4%, and it has moved up a little bit, maybe 15, 20 basis points with the latest Fed shift. So that's it's not very much so far, but it obviously something very important to watch. But if Jesper's right, and the yield curve does invert, and as I said before, we've got another 150 basis points. I mean, the Fed is, and even since the last meeting, Powell sounded even a little bit more hawkish. So you could have by the end of the year close to 2% federal funds rate. And if Treasury yields do start to come in, you invert the yield curve. What does the Fed do? Does it look at that and say, wow, that's a danger sign, we might be going too far here? Because an inverted yield curve essentially says, yes, short-term rates driven by the federal banks, the central bank stance, are high relative to long-term rates now, but long-term rates are discounting the future path of short-term policy rates, and the markets are betting that the Fed is going to have to reverse, kind of almost sending a signal to the central bank, you're going too far, you're throwing us into recession. Or will it be a little bit like the Greenspan conundrum, where back in those days when Greenspan was trying to tighten monetary policy, long-term yields were not going up, they kept coming down. So in that case, the question would be, what does the Fed do with its balance sheet? Because one way potentially of getting long-term yields up would be, of course, to unwind the balance sheet much quicker. And the whole theory of quantitative easing, according to the Fed, is that you're taking the term premium out of the market. Well, if long-term yields are not doing enough work to kind of tighten financial conditions, and you're getting an inverted yield curve, does the Fed say time to actually start offloading this extra $4 or $5 trillion of treasuries and MBS that we have? Now, they've never done that in the past. They've just relied on this gentle runoff. As the securities mature, they let them just run off the balance sheet. But they do have this card up their sleeve. Now, again, then if you're in that scenario and they do use that bazooka, to use Jesper's term, that's a risky move, because that could be the thing that actually, you're tightening monetary policy into a situation where you've got an inverted yield curve. Do you really want to fire that bazooka and double down on a recessionary risk? So, interest rate policy, balance sheet policy, how do markets react? There are a lot of very challenging moving parts here for the Fed in particular. The other thing I'll choose my words carefully, but again, I'm very much in the camp of, thinking that, the Fed has a lot of credibility. It's a very strong central bank. 400 or 500 PhDs in economics and statistics and everything else. Not that that matters too much, but, very strong institution. But at the moment, some of the quite strong members of the board have left. Powell has been reappointed, but, is he the strongest chairman in the world? There are two people who are about to join who don't have incredibly strong monetary policy credentials. And we do have this very political environment coming up to the midterm. So, I hope the Fed stay, and, that there's a vacant vice chair of banking supervision as well. That's a very important position. Randy Quarles, who was in that position, who I think was a strong player, he left at the end of last year. The person that was put up to take his place, this is, the second most important financial position, maybe in the world, was knocked back, couldn't get through the Congress. So that position is left vacant, and here we are in March. So, I don't want to overplay this point, Anthony, but there is, if you wanted to worry about something, you might just start to worry a bit about how strong is the Fed as an institution at the moment.
Okay, thank you for
Anthony.
words.
This is Hiro. This is Shirakawa.
Sorry?
Did you see my chart here?
Yep.
Can you see that?
Yep.
Okay. This is, in Japanese, but essentially this is the Fed, the security holding, and S&P. You see that? Almost a perfect correlation.
Yeah, we've got it.
And my gut feeling is that if the QT is aggressive, it's really big stress to equity markets. I stop here.
Sorry, could you say it again? Didn't quite catch it. If the what is aggressive?
No. If the QT is aggressive, that's gonna be inviting a huge down pressure on equity prices. If you believe this chart is kind of reversed, right?
Okay, thank you.
Quantitative tightening.
Quantitative tightening, QT.
No, look, look, money makes the world go round, and there's no question, of these correlations with asset prices, and the balance sheet of the central banks there, right? What is actually interesting is, Weimar, the 100th anniversary was mentioned earlier, that actually, if you look at your economic history, German at the time, Weimar Republic's hyperinflation started when the Reichsbank started to monetize the wage bill of German workers. This was after France invaded the Rhineland, which set all sorts of things go. And it's interesting because history does repeat itself in the sense of that, the real impact on inflation from central bank policy did not happen in terms of consumer price inflation, after the quantitative easing measures taken after the global financial crisis, but it did impact asset prices, right? But the impact on inflation started to come through when you had these employment support measures, actually being linked to added quantitative ease by the Federal Reserve and other central banks at the time. So it's quite interesting, sort of getting the money out of the banking and financial system into the hands of the people. That actually is something that COVID brought to the table, while the previous crisis actually did not bring that to the table. And the withdrawal of that, right, is something that's very, very interesting here. For 30 seconds, just again, since we're on a history lesson, it took 5 years of more than 5% inflation in America, for Jimmy Carter to appoint Paul Volcker, who had a philosophy to actually crush inflation. So I think we're really, as the Americans would say, in the first innings, right, of the political pressure, right, the will of the people, as it were, actually being exercised there. For Europe, I unfortunately would want to point out that there is a tremendous potentially deflationary force being unleashed from the fact that so far there is about 3 million, asylum seekers and refugees from the Ukraine that in one way, form, shape or another, Europe is committed to actually absorb, into their labor market. And then, I think last but not least, I think here in Japan, it will be very, very interesting in terms of the change of the philosophy. We do have, Governor Kuroda's, term expiring, around this time next year. And it will be very, very interesting to see whether a more independent-minded central banker will become the central bank head, or whether the nexus, the close linkage between the Ministry of Finance and the central bank is going to be maintained.
Okay, thank you. We're up against time, but I'm going to cheat by putting in one quick question, one sentence answer. In an inflationary environment, gold or Bitcoin? Jesper.
Gold.
Gold. Okay. Paul.
Oh, aren't they the same thing? Isn't Bitcoin digital gold?
That's a good diplomatic answer. Shirakawa.
Except that it can be shut down.
I think, well, I kind of believe central banks. So I'm not necessarily that interested in gold and cryptocurrencies.
So what you collect tofu?
Okay. Well, we're exactly on time, finishing time. Again, many thanks to the speakers. It's been a very interesting debate, I think, and definitely some very interesting points put out, not least the forecasts on the yen exchange rate. So thank you all for coming. Thank you for your expert contributions. Jesper, I have a 1-year honorary membership for you since you're present. So, Shirakawa-san, what is the situation with the other speakers? Do they have...
Yeah, I still have, because I got after the December.
Okay.
One.
And Koll, is your honorary membership?
I have one too, but
you don't have a chance.
I've got to get back into the country and be able to use it and visit your wonderful facilities there again.
Things are getting easier. Please come next time. It'd be lovely to have an in-person debate. Well, thank you very much indeed for your contribution.
Thank you.
Thank you.